Even though incomes are up, why are tech employees still worried?
Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Ogti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
Hi, my name is Aaron Ogti. I'm a financial advisor in the Bay Area. I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today with episode 151. And thanks everybody for listening and watching.
Great to be here as well. So today we're going to be talking about kind of the vibes among employees in the tech space, or at least I'm planning on bringing the vibes. And I'm guessing Trishul's going to bring some of the data. But one of the observations I've made in conversations with clients is this dichotomy of incomes are actually pretty up. Like salaries are up, more so towards end of 2024. Like just what's happened in the last few months has maybe changed some of this. But RSU income was up a lot. So in general, incomes were up a lot. But at the same time, layoffs were happening. And for those who had been laid off, they were having trouble finding a new job. And so even though incomes were up, both through salaries and usually RSU income, but stock options as well, no one felt great. Everyone kind of had this feeling of like waiting for the other shoe to drop idea. And I wanted to discuss kind of this weird, like, numbers look good, but no one feels great idea as it relates to layoffs, the tech space, and there's like the specter of job loss kind of looming over how people approach just going about their regular lives. So I want to kind of I want to set the stage. Like going back to 2023, things seemed fine-ish, I guess I'd say. Layoffs kind of started happening, but tech stocks were going up, so RSU income was going up fairly dramatically. And there's this one, like, if you were, I don't say lucky is not the wrong word for this because most people kept their job, but if you still had your job, things were great. But if you didn't have your job and if you got laid off, like, oh, man, it might take a while to find a new job. And this is not just my employee or my clients. My wife has maintained contact with others in the tech space, and there was a similar vibe of those who had been laid off were having trouble finding a new job, but those that were still working, things were looking really, really good. And I, I couldn't quite remember this idea happening in either other industries or any other historical examples of like things are actually good. Like income is up, but no one feels like things are actually good. And I wanted to kind of just hash out this weird conflicting feeling with you, and wanted you to kind of give you like one. Have you seen a similar observation in any of your clients, or is that just because my clients are in tech, my wife's in tech, and I'm in the Bay Area? Is that, or have you seen a similar feeling elsewhere?
I have, and I don't know if this is enough data to espouse a trend, but I've heard of a few data points along the same lines. Yeah. And it does have me thinking always when I hear that, okay, what does the data actually say? Right.
Okay.
Yeah.
So
That's kind
like
of where my mind goes.
our sample size are just kind of too small to draw any kind of conclusions or even guesses. Is
Yeah. Yeah. And also, I think even The news headlines can be a little bit misleading because you can
Mm,
hear, 10,000 jobs cut here at this firm, 50,000, a few thousand here at this job, and each one is a separate headline that could make the front page of the news, right? And you might hear this um, every other day, right?
okay.
Over the period of months, and yet it might give the impression that this guy is falling.
That I have an okay. I have a note I'll save for later. It was one of my wife's jokes slash. It's probably too true to be funny, kind of thing. But we'll go on.
I was hitch something else onto that. For example, um, if you follow like the headlines for like the market, you might hear down 2% in the news or like down 3%, but you may not hear the plus 0.25, the plus 0.3,
Yeah,
right,
yeah,
over the
yeah.
week, realizing that over the month you're flat, even though all you've heard are the 5 negative days that were big downs and not the incremental positives. And if you're flat over a month, then what really happened? Well, nothing. So you've got a lot of negative stuff that's flowed through the news, so the perception could be starkly negative.
That's interesting. So, I guess if I had to guess, the perception of things being negative. And again, for this conversation, I want to try to go back to like end of 2024, beginning of 2025, like before tariff stuff started becoming a different issue.
Mhm.
How often do we see like conflicting news of like stocks are up, layoffs are up?
Well, okay, it depends, right? Here's the caveats,
Yeah,
right? Because you
classic
can have
financial advisor. It depends. Like, go on.
the overall economy can be up, but a certain sector might be doing some restructuring for whatever reason, right?
Okay, but in this case, the tech stocks specifically were
Yeah.
up, and layoffs were up. And
Well,
I have
okay,
a
so I have a
couple.
crystal ball, or I can postcast on what was going on,
Okay.
but I don't know if that's what you want out of me.
Well, okay. So a couple factors I think come into play.
Yeah,
It's like um I don't know which is the causation, but when there are layoffs, a company's expenses go down,
yeah,
and if they can maintain the same revenue, that means they're now more profitable. So that
r- yeah,
could be it could be the layoffs themselves pushing the stock price up a little bit.
yeah, yeah. If the market has this impression that these companies are bloated and they do trim the fat, then the stock will be rewarded, right, by making these structural changes. And I think that that was my postcasting spree that
Okay.
I was going to mention. Like essentially, what we saw over the last few years is you had the pandemic, right? You
Hmm.
had the government putting a lot of stimulation into the market. The main one being like lowering interest rates, right,
Hmm.
to basically zero, like 0.5%. And that caused a huge hiring spree because you had like free money for all these companies to go out and hire employees and build and expand and grow, grow.
Okay.
And so you saw a lot of these companies, including in technology and Silicon Valley, expand incredibly, increase their workforce incredibly. And then you had things change with interest rates rising, right,
Yeah.
over 2024. So you went from like 0.5% to like, was it like above 5%, 6%? What was it?
Yeah.
Would it
I
peak
think
at?
it got over 6 at one point.
Yeah, so you went from like free money to very expensive money. Like, and yeah, what's that gonna mean? Well, that's gonna mean we're not gonna hire so much anymore, right?
Okay.
We're gonna maybe we hired too quickly as well, right? Now that things are gonna slow down inevitably with our clients and our customers and the economy, let's see if we need all of these employees. If we hired, 100, let's trim 10, something like
Okay.
that.
Okay. So that does kind of echo a couple other things I've noticed. Like going back, I think it was 2021 or 2022, I had like one of the biggest IPO years ever. And
Mhm.
I had not associated it with the interest rate idea, but that makes sense where if you have capital to invest and everything on the fixed income side is 1% or less, and maybe if you took a risky debt, then you might
Mhm.
pick it up to 2. It makes a lot of sense to start investing on the equity side and probably invest in private equity, and that's where you got kind of the IPOs.
Mhm.
On the flip side, I can kind of see, okay, now if I can get a 6 to 10%, depending on the risk of the fixed income,
Yeah.
then I maybe don't have as much of a reason to invest in an IPO, where now my hurdle to clear is higher compared to my kind of opportunity cost. And that has kind of lined up with we see a slowdown in IPOs.
Mhm. Yeah. And the a few other things to note on the backstory is inflation has come back a lot since what it used to be, right? So that was part of the impetus behind increasing the rates in the first
Mhm.
place. But now you have interest rates like CPI, core CPI I just looked up was like less than 3%. Now, there's going to be some caveats because of what's
Yeah,
going on, which we haven't mentioned yet, because of
yeah,
all the tariffs and all the Trump transitions that are going on. Let's say what we're saying so far has been the case up until January 5th or something.
yeah, yeah, yeah.
We'll certainly touch on what changed since then. But yeah, up until then, I would say, you had interest rates still pretty high, and you had inflation come down, so that there's a strong impetus to take that risk-free return or take that marginal return rather than expand your business, borrow at 6 or 7% and try to make some 12, 13, 14%, right?
Yeah,
Harder to do. Take
yeah.
the easy way out.
So the thing I was going to mention, and because this actually, I can see the MBAs in the C-suite kind of doing the math and applying some of this, because my wife made the joke of, even if tech companies were financially healthy,
Yeah.
like this is the time to lay people off, because there's like enough social cover that if you're just one
Yeah.
of a couple dozen companies
Yeah.
laying people off, it's a normal thing.
Yeah. Yeah.
And so that, like,
Right.
cutting the bloat idea, like other, like I can see other companies would kind of apply that as well, of like, okay, how do we reduce our expenses if our borrowing costs have gone from 1 to 5?
Yeah, blame it on the Fed. Should
Yeah,
take the easy out. You have no excuse if rates are at 0, right? But if
and I see, like, some of the math that, like, private equity firms will do, like, maybe this is being applied by boards of directors and a lot of the CFOs and CEOs across some of these companies.
yeah, it could be the scapegoat. For example, the other backstory, which has obviously played out to some extent and will continue to play out, is the whole AI thing, right? Like the fact that there is some notion that the AIs are getting pretty good at coding, and that might put pressure, maybe on like certain parts of um, the software engineering pipeline, right? Maybe like
Mhm.
lower level coders will be less in demand, right? Or maybe some parts of like quality assurance can be tested far more efficiently with less overhead. You may need more like higher level architects, something like that, but less lower level engineers.
So that's an interesting premise, and I don't want to discount it.
Mhm.
I just haven't heard that as reasoning from anyone.
Well, that's just it. You're going to hear the scapegoat being interest rates, right? Because Meta's
Yeah,
not going to say your job's going away because of AI. They're going to say the job's going away because of Powell and the Fed, right?
yeah, and I agree. But, like, I also know people on the hiring side
Yeah.
that they haven't mentioned anything like that. I have some clients and friends who are in the management side of some of these tech companies, not CEO level, but
Yeah.
they're high enough that it doesn't seem to be AI related, but I don't want to, again, I
Yeah.
acknowledge it could be.
Here's how I might see it. I think it might give firms a pause, the people in the MBA room, right? A
Yeah, yeah.
pause on, let's rethink our hiring strategy for 25 and 26. Meaning, let's not hire so aggressively in the areas we plan to, right?
Okay.
Um, let's also use the opportunity of high rates to trim the fat, maybe.
Yeah, yeah.
And let's think more strategically on how this is going to impact our future growth.
So okay, so it may maybe it was like that instead of that just trim the fat, like, there's like they have to actually work now. Like the MBAs have to do their job kind of thing. Like
Well, they got to pay
before
their
it's
own
just like
salaries, right?
hire everyone like no cost, like don't have to be like just doesn't matter. We'll just keep like throwing free money at the problem. And now they have to actually figure things out.
Yeah, well, it's one of those things like that's true in many industries, right? When things are good, it's a green field and you can do whatever and you'll still be okay, right?
Yeah, there's a lot of acronyms like the rising tide lifts all boats, but like
Yeah, like
um
even in investing, if you're investing in a bull market, it's going to seem so much more fun and straightforward when times get tough.
isn't there isn't like a Warren Buffett quote of like you don't see who's not wearing pants until the tide goes out or something like that?
Sure, might be a Munger, but I don't know.
I'll see if I can find that for the show notes. But same idea of like, yeah, it's like maybe just things are going well, so everyone's job is easy, and
Well,
now things are not as easy, and it's a hard problem to solve.
Well, things were a little too good when you had interest rates at 0.5%. That's not sustainable, right? Money shouldn't be that free. And RSUs shouldn't rise so quickly, so easily, right? Valuations in stock and overall compensations aren't typically supposed to be that um, positive on a year-over-year basis as they were for that,
I
that period.
I probably had a couple clients whose RSU income went from like half their salary, so they a third of their income is coming from RSUs, to all of a sudden it was double their salary, where their salary made up one third of their income.
Yeah, yeah. Look, at the end of the day, there was a dip in valuations in the market over the pandemic, but it came back so quickly and then it roared upwards to like an
Yeah,
all-time high over 2024. So you had a pretty nice bull run that, made the dip of the pandemic seem like, I don't know, a walk in the park.
okay, so I think there's two paths I'm going to go down with our discussion. One is, so how should these people feel? How should like
Mhm.
tech employees kind of feel? But the other might be, we kind of rolled right into tariff related concerns, and the tech stocks have come down in the last few months, and it almost like their fears are justified, but not for the right reason. I don't know how, like, does that make sense, or is there? You see what I'm saying?
Yes and no and yes. And maybe no. I'm gonna come out and no. I don't know. Let's talk about it.
Okay. Let's without trying to like date this too much, but the idea of, yes, now stocks have come down, so their 2025 RSU income is probably closer in line with their 2023 RSU income rather than the 2024 RSU income.
Okay. Well, I think we got to say it's not July right now because
Okay, that's fair. It's we're recording this in end of April.
okay, so we're a few months away from release date
Okay,
because we plan
that's
on
fair.
taking some
W-
vacations or
yeah,
something.
yeah. Okay, that's fair. We gotta We got to timestamp this one.
Yeah, if certainly, because again, in the bigger picture, maybe I can share a screen because I haven't even let's see where stocks are, because I would say in the grand scheme we're still near that all-time high in terms of
I was having a conversation the other day. Like the S&P 500 is still up, over the 1 year trailing.
yeah. Okay, here we are. So let me share some things. Which is the
Okay.
one? I like how we can be in the bottom corner somehow.
Okay.
How was that? Was that
There we
this
go.
one?
Okay, I
This
like
one?
that.
Okay. All right. So this is the 1 year trailing. Yeah, and we're still up 6% year over year, right?
Yeah.
And a 6% return, from last year to this time this year sounds pretty good for investing in the market, right? It's not horrible. That's not the skies are falling territory. Now, certainly year to date, we're down 12%.
Yeah. I
I don't,
think 2024 was up like 24, 25% or something like that.
yeah,
To the calendar year. Yeah.
right. Sorry, I didn't even grab the right day to day. So we're down about 10% this year. And
Okay.
then, yeah, let me show just a year over year. For 2024, market was up 20, S&P, sorry, I'm showing S&P
Yeah.
here. S&P is up like 26%, add a percent or two for dividends. What a solid year, right? And then you got to
Yeah.
give back of 10%. So
I think
over,
that's the other context. I was like, when I was putting together a conversation for a client, I believe 2023 and 2024 were the first time in history we had over 20% in 2 consecutive years.
back to back.
Yeah. So like, yeah, this 10% drawdown from a plus 50% return over the previous 2 years. This is like when we talked about the like I don't care about the market feels like, yeah, I look at this chart like, yeah, this feels very normal.
Yeah.
But that's why I want you to finish. Like I want to get to like how people actually feel. But yeah, go
Okay.
ahead.
Well, just before I leave this, here's how it's been over the last 5 years, up 90%. Right. So, meaning 100% if you take away the last few months.
Yeah.
And this is, from the pandemic, right? Basically, was that I wish, okay, let me go back a bit further.
Yeah. I'm actually curious if the NASDAQ, what that's been look like. I have not looked at that one yet.
Sure, we can do the same type of deal with the NASDAQ. Okay, so
NASDAQ, same 1 year trailing, year to date, it's like negative 13. Okay, it's more or less the same.
yeah, so yeah, 1 year trailing, just for our listeners, up
Oh, good
7%.
call.
And year to date down 13%.
Yeah.
And then 5 years still up 94%, right?
Yeah.
Even with the downturn this year.
Yeah.
So it's one of those things, again, if you read the headlines and you're just listening day over day, you might just hear negative, negative, negative. But if you actually zoom out and look at the data over a longer term history, I don't think anybody would say up 94% over the last 5 years is something that is a major reason for concern.
Okay. So going back to like when I said the
Yep.
tech employees felt bad, and then kind of tariffs came into play, and we saw a big drawdown. So they were like, fear was justified, but for the wrong reason. What
Yeah.
you said, that wasn't. You said yes to no, then yes was settled on no. So like, do you want to elaborate that?
Yeah. So, again, the reason I landed on no is, again, are things really that bad, right? Just looking at the data and the market and how much things have shifted. So that's where I probably come out with the no, but there
Okay.
is some yeses in there, because it's not great to have all of the volatility coming, from the turbulent, all the uncertainty around the turbulent space, right? The tariff space. So it doesn't necessarily make things smoother, right? We want to be focusing on growth and growing the pie, and tariffs will likely, shrink the pie.
Mm-hmm.
Hopefully, it'll allow some restructuring in the way that these trade imbalances are in existence, especially to the level where maybe we have some national security concerns because we aren't able to produce certain things in the US. But all of that is pretty far from being resolved, or even, I don't know, heading in the
Yeah.
direction towards resolution.
Okay. So the other thing I want, so I kind of agree with the idea that from an economic perspective, this is kind of normal. This is like normal volatility. We expect this every decade-ish. Layoffs happen, and so even though incomes were up and layoffs were up, there wasn't anything particularly actionable. Like there's nothing that stands out as unusual. From would you agree with that idea?
I do, but I did mention I have some data, so I'm just a
Okay,
little
okay,
eager to make sure we drive that point home. So let me just share it. So,
okay.
okay, so here, for example, one of the headlines was Meta laid off a ton of people, and you can see the trend in the employee count where they went from like 6,000 employees a decade ago, and then they had like 87,000 with year over year growth over from 2021, like
Okay.
15K. So yeah, and then they had their first major downsizing since probably ever, right?
Okay.
Now that was the headline, though. They're laying off 11,000 people, but compared to the strong growth that they had for the decade prior, it is more like a pullback rather than the sky is falling with their head count. Now 11,000 people is no joke. It's a small city, right? But
Yeah.
at the same time, in the larger context, it could be more of the trimming the fat or going through a business cycle, and then some other numbers that I'll
So that's
probably
like
throw out there.
13% of the workforce.
Yeah, right. So, just some other numbers in terms of the overall picture in
Uh,
2024. Yep.
Sorry, real quick for our listeners, Trishul showed a graph as a bar chart that showed multiple growth for what 12 straight years,
Yeah, for a
and
decade.
then the very last one we dropped from 87,000 down to, was it 71,000 or 73,000, something
Yeah,
like that.
about 13K drop,
Yeah,
11K drop. Sorry.
yeah. So 11K drop from 87, and that's where we get a 13% drop.
Yeah, and here's just some more data. In 2024, our tech laid off 150,000 employees, so a
Okay.
lot of people, right? But this is across 500 companies, and the trend so far in 2025 is at a slower clip so far, maybe about 30K people in the first quarter. So things aren't necessarily accelerating in the layoff space in technology. And then, just putting this in the framework of the bigger picture, as we mentioned, core CPI is down, and overall in unemployment is still quite low, sub 3%.
Yeah.
So in the grand scheme of employment and even in technology, the numbers even indicate things are still looking pretty good.
Okay. Okay. Hmm. So now I'm trying to I'm practically empathizing with my clients,
Yeah.
imagining being in their shoes. It's like, thank you for that data. It does not make me feel better.
Right. Yeah, of course. If you're in the shoes of somebody in
Yes.
that bucket, then yeah, things aren't quite the same. Now I would
So I
say
guess
though,
I want to,
yep,
when you say either things aren't that bad or like they're normal-ish.
yeah,
Do you actually mean like just things aren't that bad? Like
I,
do you want to clarify that or add some color to that?
it is. Well, okay, so compared to the dot-com bubble, right? So
Okay.
things are starkly different now, certainly, because a few things happened at that time that are different than now. That time, a lot of these tech companies were very nascent, just
Hmm.
budding, barely off the ground. N- Profitability wasn't a main concern, right?
Hmm.
A lot of these technologies were going from like paperless paper to paperless, right? So
Yeah.
it was just a lot more friction, right, to incorporate these advancements. So the speed at which the financial markets wanted things to go was far faster than the actual
Yeah.
change could have been implemented. It's just too much money too quickly that led to the boom and bust of that era.
Okay.
And at that time, we saw systemic um, reverberations from the tech industry across the entire economy, right?
Okay.
The whole market ended up down. Overall unemployment ended up going up considerably. Whereas now, unemployment actually decreased last year overall.
Okay.
And in the tech space, there still has been those 150,000 layoffs, but um, even in the tech space, unemployment is still quite low, meaning people are looking for jobs, people are getting hired. It's not one of those cases where in the early 2000s, just these companies didn't exist anymore. And,
Yeah.
these positions weren't there at any capacity. And then, the other secular change is we have this tailwind of AI saying, hey, we need to use this technology. We need a bunch of people to figure out how to use it,
Hmm.
not only at these tech firms, but basically all these other firms which lean on
Yeah.
technology.
Yeah.
Before any other firm basically had rudimentary tech, but even non-technology firms have a ton of tech now. They need
Yeah.
developers and software engineers and so on. So I think it's one of those cases where maybe the big Silicon Valley companies, tech firms are trimming back, but overall tech in general seems promising.
Okay. Okay. Uh, I appreciate that. I can. That's a good context. The next area, I'm actually like again, it's kind of like if you're having a conversation with a client, like again, can't just throw data at them, but how to help people deal with their feelings, especially like either they're working
Yeah.
and or maybe they have been laid off. So kind of
Yeah.
what are some of those things that you talk about with clients, not necessarily tech related, but just
Mhm.
that idea of yes, it is possible to get laid off. I have a couple of things I want to get to, but I want to give you the opportunity first.
Yeah, yeah. So it depends how far we're along in the process, but if we do have a full built out plan, it's likely we've already discussed the notion of what happens if, for example, you stress test the plan with um, a double income household going to a single income. See
Mhm.
what impact that is to monthly cash flows, things like that. Um, how will the emergency fund support a situation when there's no employment income coming in? So
Okay.
these are all the different scenarios that we can consider and interrogate on a one-off basis. The big thing, if something does happen, is really do take a concerted look at that cash flow picture, right? Because that's going to be the more acute concerns that you want to think about. You want to make sure that your monthly bleed, right, is
Mhm.
sensible, and it's a good time to take a stock, right, of your situation. For example, look at that budget a little bit more closely and see, okay, what is the total amount that you need to cover yourself, and where does that emergency fund put you? That can that exercise alone can maybe relieve some stress, right?
Mhm.
And you had mentioned with some of your clients they like to keep a larger cash position,
Mhm.
and just doing that math to realize, hey, we have 12 months before we need
Mhm.
to make any serious changes left or right. And if we make these opportunistic changes in our plan, then that can increase to 16 or 18 months, right?
Yeah.
Maybe we're going to stave off that big vacation. We're going to take more local trips next year, over the next year.
Yeah.
and we're gonna cut out the 3 times a week Uber Eats and maybe do once a week, or small things like that if necessary. But the point is, just going through that exercise can provide a good amount of short-term comfort, just realizing where things are.
I that is the short answer for me, is just what is your cash reserve?
Hmm.
Whether it's phrased as an emergency reserve, opportunities, like for some, even the ones who are working, that they felt concerned as we're going through, like, we sold your RSUs, and for 2 years now we've had this plan of sell your RSUs, set this much aside for taxes, this much is going to go to this other taxable investment account. We've been doing this every quarter,
Yeah.
and we get to a point like, you know what? It's okay after you sold your RSUs to not immediately put in that taxable investment account.
Hmm.
It's okay to just hold on to a little extra cash. Okay. And we have a plan. We actually picked the date, and we have a plan of when we'll get back in, kind of regardless of market ups and downs. But that larger cash reserve is one of those things that I have seen directly help how clients feel when it comes to some of these concerns. And it's
Hmm.
actually, it does both. If you lose your job, here's how long you can maintain your exact lifestyle without any changes
Hmm.
until you find a new job. Usually for a dual income household, one losing their job is not as devastating, because we could even go into something like the other spouse stops saving in their 401k for 6 to 12 months.
Right.
And that actually, for a decent number, if you remove that saving side, like, oh, they could get along as one household income on one salary for several years, if
Hmm.
not theoretically indefinitely. They need to get back to saving at some point for most situations, so that's why it can't be indefinite. But
Yeah.
like, okay, you can maintain this level for a while, and then when the other spouse goes back to work, okay, and that's when we get back to our saving. So like
Hmm.
we have a variety of those kind of mechanisms in place. But at the same time, it's also that large cash reserve. When you see the stock market go down, you see all the bad news and the headlines, just look at your cash reserve and like, okay, I'm fine. My paycheck still hit my checking account, and my cash reserve is still there.
Yeah.
And I have noticed the psychological benefits of looking at that. Don't look at stock market news, ignore your 401k, ignore the stock price ups and downs. But if you have a healthy cash reserve, that can help, like, your emotions and feelings weather a lot of the news that's trying to make you feel bad.
Yeah. Yeah. If you realize that you have the cushion and you have gone through the exercise of seeing how long that will last, that can lift a lot of the uncertainty that
Mhm.
probably it can weigh many people down. The other thing that's going through my mind is it, it's a big difference also if you can pull in just some sort of income on a short-term basis. If you just take a contract
Mm.
position just to not only fill up your time but just be a little active and um, be a little sharp on your skills, not let them atrophy too much. Just working 10, 15 hours a week, something like that, it might be enough to bridge any gaps, right?
Yeah.
In that single income household case, or even let that emergency fund and that dual income household case be more solvent for a longer period, much longer, indefinite, essentially.
Yeah. It's I don't say indefinite, because they still need to build up some savings for long-term financial independence.
Yeah.
Uh, and so it would, I guess indefinite would be like if they were willing to work longer, just let what their current savings just grow. But it might be like sometimes they're going to scale that back that much. Like, okay, the other spouse needs to work 5 to 10 years longer.
Potentially, yeah. So this came up in looking at our timeline in the last conversation that just got released, I think, or maybe 2 conversations ago. Okay, but if you can earn 30K on a part-time basis per year, then you're taking out 1 million that you might need to
Oh
save up
yeah,
in your net
as our
worth,
our
right?
compounding conversation. Yeah.
Yeah, yeah. So if you're 3 million away from your fire target or your financial
Mhm.
independence target, if you were earning, a couple hundred grand, median meta income with RSUs is about 300,000.
Okay.
Let's say you can just replace 90K on like a part-time basis. Well, that.
See, I think that's not a safe assumption, and
Mhm.
that's one of the things that comes up is there are a lot of people in tech who would actually be happy with half the income for half the time, and that kind of doesn't exist. It's they would have to go down to 50 to 70K. So it'd be like a quarter of the income for half the time. And
I
some of
don't
them are
know.
okay with that, but
Yeah.
th- they have not been able to find that kind of role other than trying to like start their own business or only consulting and kind of controlling their time that way. Like
Yeah.
it, there are stories of it's theoretically possible, but it's not easy.
Yeah. Well, so I guess if you're gonna be doing it on a longer term basis, then it probably is a practice at that point that
Yeah,
you're putting together. So then, okay, so I'm gonna hedge or maybe backtrack a bit. If it's on the shorter term case, then yeah, you're probably not gonna get the one for one, downsize.
yeah,
But I'd say if it does end up being a practice, then that could pay dividends so that you could potentially get more
yeah,
per hour than you might as an employee.
yeah.
Um,
I would say for those who are looking at part time, it's a complete career change.
yeah,
It's a different field. It's something else that's more of a I don't say passion project, but they end up working in the community, working at for a local government. A couple independently say like they'd like to work at the library. They like to be librarians.
yeah,
Uh,
yeah. Well, so again, if you're a million or two away, 60 grand, if you have marketable skills, even in the technology space, it does transfer to
yeah,
some, yeah. So, uh, like in a lot of the plans that I go through with clients, we do play the hey, what if we went part time?
hmm
What would this mean in terms of the plan? And this just might be one of those excuses to lean on to make that transition sooner than anticipated.
so that's that is interesting. I I don't think I've tied those directly, but I have so I have looked I have done plans for dual income households like not because of economy reasons, but for lifestyle reasons. What if you went down to one house, one income?
Uh-huh.
Like what does that look like? What does your lifestyle look like? And kind of matching that, what does the finances look like? So
Yeah,
I have done that for almost all of them.
yeah, yeah.
So yeah, that's it. I guess I had not thought of using that same math as like job loss emotion protection.
So it may come up more if somebody has some buzz of some uncertainty, right?
Yeah,
That they've already been a first round of layoffs and I've been okay, but hey, let's look at this a little more
yeah,
closely, right? One of those types of situations. But yeah, in many of the cases, it's what if I stop working, but my spouse, kept working, because
yeah,
sometimes it's like the spouse is like, I want to keep working indefinitely. I don't
yeah.
see why I would ever stop. And the other spouse is like, I'd like to get out as soon as possible. I'm not saying,
I
I
I think there have been a couple cases that come to mind where the wrong spouse got laid off. It's like incomes are similar, but like the one who wanted to stop working now is the sole
Right.
breadwinner. And things are like they're fine, but like the one who
Yeah.
wanted to keep working indefinitely, they're the ones who got laid off. It's like I guess they're going back to looking for work somewhere because that's what they want to do with their time.
Right. Yeah.
So it's I think this is another reason why I love planning with couples and dual income households. Like it's not just the okay, you're both saving lots of money and we'll get there eventually. It's you can actually design your ideal life, but it's not each of you individually. Like they really have to plan together
Hmm.
and figure out what is our ideal life and how do we work towards that.
Yeah, that's fair to say, because you have more degrees of freedom, basically n squared, right, in terms of the opportunity to shift things around or permutate through different options.
Mm-hmm. There is a concern sometimes that lifestyle expenses can actually get even higher if they have the dual incomes to support that. And so it's just again with anyone else, it becomes a different type of risk that they're taking on.
Yeah, yeah. This maybe dovetail. This highlights, for example, again, the last few years have been pretty kind of good, and it may have been a little too encouraging for lifestyle creep in some areas.
Yeah.
Um, and I heard it also doesn't help with like the vicious cycle of housing prices go up, so cost of living goes up, and then
Mhm.
people earn more, and then housing prices go up, and then cost of living goes up, and then
Yeah.
people earn more, and then all of a sudden you're paying so much more for just living in the same place. Uh, it's a little hard to sustain with these types of disruptions, these big disruptions in employment.
That is, you know what? That is a great perspective. I have several clients who feel more comfortable by having a plan for having to pay off their mortgage.
Mhm.
And because it's not just like the dollar value, it's also when combined kind of with interest rates, they're looking at between uh, principal and interest, property taxes, and insurance, like the uh, 10,000 a month for some of them, where if they can pay off their mortgage
Mhm.
and they're going to save 8,000 a month there from that mortgage payment,
Mhm.
that is a good point where when it comes to trying to live in the Bay Area and you have the incomes to support that, but it is one of those things of it gets hard to go back down to a one income household when you need both incomes to pay your mortgage and live your life.
Mm.
Yeah,
Right.
it's buying a $2 million 3-bedroom house with a $1.6 million mortgage because you already you use the company stock as your 400K down payment.
Yeah.
It's like, yeah, you, you can do this, and it works just fine. Most people, ends up what most people end up doing, but it does make it hard to have that like, okay, if one of us gets laid off, can we still go down to one income when you have a mortgage payment that high?
Yeah. Yeah.
So maybe that's part of uh, the factors that I see with my clients that are a little different. Um, and it's from the same perspectives, actually, why I designed my firm where I my fees based on net worth and not assets under management. I see fairly, I don't say regularly, but a decent number of my clients are happy to take money out of investments and pay down their mortgage. And so that ends up becoming one of the things we work towards because it helps them feel more secure. that they
Mhm.
feel better, not necessarily seeing the cash or the investments, but having that mortgage paid off.
Yeah.
Where from a financial planning perspective, we can use like a home equity line of credit as their emergency reserve,
Hmm.
where something really, really happened, they have an asset that they can access a little bit of.
Yeah.
But yeah, I had not thought of the layoffs in tech in like in the Bay Area relative to their mortgage, but that does make sense. Yeah. Do do you see do you have any similar observations about how people are whether do they have a level of concern that is correlated with their mortgage, you think?
I yes and no, but like I would say, um, West Coast is a different phenomenon when it comes to that because you just see um you just see much higher mortgages out there, right?
Yeah.
Even as a function of income, and um, I did have a client who went through a rough patch with a layoff, and I think some of the feedback was it's just it feels better if you're less beholden to the paycheck,
Mhm.
from many perspectives, and it just gives there's a certain sign of comfort knowing that you don't need that paycheck to make ends meet,
Mm.
um, and I think they appreciated that feeling a bit more, in terms of how they may situate themselves going forward, having gone through, like this round of tech
Mhm.
layoffs.
Did they have a decent cash reserve to help deal with that feeling?
Yeah, it's one of those again. Hindsight's 2020, right? If you had the chance to, live more modestly and
Mhm.
be on more firmer footing for financial independence, of course, you can't change the past, right?
Yeah.
But I think um I think that that's something they saw that they maybe hadn't seen as an option,
Mm.
you know, f- on a that they can employ going forward. That maybe just putting more focus on independence than they had been.
Oh, I see what you're saying.
Yeah.
That if their initial plan might have been, I'm happy to work till I'm 60, 65. I'm gonna keep saving, enjoying my
Right.
life. But the layoff's like, oh, if I can be financially independent sooner, that
Yeah.
combination of building up savings more makes things more resilient, managing expenses a little bit more, makes things a little more resilient, and having a plan like for on the track for financial independence sooner
Yeah.
does help you survive those layoffs and other kind of exogenous events as well.
Yeah, well, so obviously things can always be more complicated in practice, but
Yeah.
I think what it actually ended up being is their mindset coming in is they were on track for their 50s, but then when we
Mm,
did the full accounting, it ended up being the 60s, just given, once you add everything up
yeah.
and project it out, that this is what the numbers are saying. So that's a hit on its own a little bit, right?
Were they I'm guessing they were saving was like 10% in their 401k, and as their
Yeah.
income went up, it drifted down to like 9 or 8%.
Well, these are themes, right? And that could be
Yeah.
part of the themes, but just not being as prudent with or focused on that, as they could be.
Mm,
Um, and lifestyle creep and all those other
yeah.
things that can add
Yeah.
up. So again, lifestyle lifestyle creep doesn't mean that you just burn the money, but you enjoy it, right?
Yeah.
That's
Yeah.
so it's not like the money's lost or just thrown in a fire. That things are good when things are good, right?
Yeah.
But it just gives you another focus on how things could be, especially if, again, the employment market doesn't behave as nicely as you want it to be.
Yeah.
Yeah.
Okay. I I appreciate that conversation. I don't know if I feel better, but I think I do have a little more context for how my clients might be feeling and dealing with some of these uncertainties at these times. That it's and as we talked about, it's like each one was a little different.
Yeah.
One did have the higher mortgage balance. One did have one spouse had been out of work a little bit longer. One did have like one was the spouse who'd been ready to stop working is the one who kept her job, and the other one was laid off. So like, so each one is just a little different,
Yeah.
but yeah, they're all going to be fine, even
Yeah.
though they may not feel like that right now. That's hard for me to just tell them like, yeah, you'll be fine. Like, but really, how do you know? It's like, well, I'm pretty sure you're gonna be fine. Like, here's all the reasons that I but like, I've been doing this long enough. I know you're gonna be fine.
Yeah,
So,
well, that I think going through the exercise is helpful. Just seeing,
yeah.
here's where things really are, right? And here's what can happen if this, is a prolonged event, and so on.
Okay. I had one other thought, but I'm worried it's gonna take our conversation way too long. Um, I was having a conversation with a client. Like, okay, she is like, okay, what if this bad thing happens and this bad thing happens and this bad thing happens? And I was trying to like tell her, and I didn't do a great job at the time, but I think you'll appreciate this. Like, okay, so we'll take this 10% risk and this other independent 10% risk and this other
Right.
independent 10% risk. So like, you're worried about this like 0.1% chance thing of happening
Yeah.
when you can survive any two of those. And yes, if all three of those things happen, then things look pretty bad.
Mm-hmm.
I don't have an immediate solution, but also we're compounding these unlikely events to a point where I don't think this is reasonable planning.
Mm-hmm.
Because it was gonna take something like stock market drop, both laid off, and there's like one other thing on top that I forget.
House burns down.
Yeah. It was something like that. Like some of the they like we needed like a new roof or exactly. It was the stock market's down, you're both laid off, and uh uh insurance covered like something that homeowners insurance doesn't cover.
Yeah, right. An event that
Yeah,
home insurance doesn't cover. Yeah.
yeah. That was it. It was okay.
Act of God.
All three of those things happen at the same time,
Yeah.
you're right. We don't have enough cash set aside for that.
Yeah.
It's
Yeah.
we can cover any two of those,
Right.
but we're currently not planning on that incredibly unlikely confluence of events.
Right. Here's how I kind of see it. First, there are ways to deal with low probability events, right?
Mm-hmm.
That can have massive impact should they occur. So, that's why insurance is there, for those
Yeah.
types of things. Now, the stacking, this is how I kind of see it. You only have you can't spend the same dollar twice, right? And you can't worry about an infinite many things.
Yeah.
So you have to divert your attention to the things that can give you the most amount of impact, for example, per dollar spent or per time spent worrying. For example, the way I like to think about it is you can look at the relative risks and divide your resources accordingly. For example, I've seen situations with clients where they have full comprehensive coverage on their automobiles, right?
Mm.
But they're a single income household with no disability insurance.
Oh,
So you get into an accident, the insurance company writes you a check for a new car, but you can't work anymore.
yeah.
Like, you can't spend that same dollar twice, right?
Yeah.
So the other thing I like to say is life is risky, unfortunately, right?
Yeah.
And if you indemnify yourself from every single risk, you literally won't be able to move, right?
Yeah. Yeah.
Like, for example, starting a business, there's a large amount of rewards, but when you start a business, you can't possibly cover all of your bases immediately. It's just
Yeah.
not possible. Like, you can't hire the best accountant and the best lawyer or the best everything, right?
Yeah.
You have to do your best with the resources you have, otherwise you'll never get off the ground. And if you get like every single insurance policy a business could have, then your return on the business is going to be the risk-free rate, right?
Yeah.
Like,
Yeah.
you won't make any money.
Yeah.
So, part of existence is taking calculated risks, right?
Yeah.
There's nothing you can do about that. If you want to live, you have to take some sort of risk. And I say that because there's the risk of starting a business and there's the risk of not starting. They're both
Yeah.
risky,
Yeah.
right? So for any endeavor that you take on, there's going to be risk. There's a risk of investing in the market, which is risky. There's a risk of not investing in the market.
This reminds me of the serenity prayer idea of the serenity to accept things I cannot change. And
Yeah.
like, okay, of those three examples, like you lose your job, stock market goes down, and your house burns down, like you can't control two of them. The stock market and the house burning down are outside of your control. So it's not worth your mental energy. Like you do like the normal, like make sure your kids don't play with fire, they don't play with matches while you're not there. Like there's normal, prudent things you can teach them, but just keep doing your regular daily work routine. Like do a good job at work and you're less likely to be laid off. And like and you can actually actively influence the unlikeliness to be laid off. Like if you put more effort into your work because you're concerned about being laid off, then you'll probably reap rewards and benefits from that. It's
Yeah.
something that you can control. It's where you should focus.
Yeah. It's like, going to a doctor and saying, I don't want to get cancer.
Yeah.
Okay, that's great. But if you do these 10 things, you'll reduce your rate by 95%. But I'm sorry, you
Yeah.
can't go to zero.
It's also, I think it's a little bit of a like you go to the doctor's like, I'm worried about dying from cancer. It's like, well, you're overweight, your pulse is bad. I'm worried about heart disease. I think you just need to exercise more.
Yeah. So there's a lot you can do to make things a lot better than had you not do those things. There's a lot of low-hanging fruit, for example,
Yeah.
but you can't squash out every single risk down to
Yeah.
zero. It's just not possible. And the amount, it's like, it takes almost no energy to go from like rest to like 1% the speed of light, but it takes an infinite amount of energy to go from like 99% the speed of light to 100%. Right?
Yeah. Not sure that's the best analogy to end on, but I think we're going to end there anyways.
Sure. Good conversation, Aaron.
Thank you very much, Trishul.
All right. Thanks, everybody, for listening. If you enjoyed this conversation, do give a like, especially if you made it to the end, because every like helps. Thanks. Bye.
Bye.
Whoop.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.